Good afternoon. This is Ken at Tortoise Capital with a review of the weekend trading reports for November 24th, 2018. Market has descended into bearish volatile conditions. On an annual basis using NDX 260, we are at the edge of neutral at 25 out of 100. And on a 10-day NDX for short term, we are extremely oversold with a score of 1 out of 100. In the market mosaic, price with respect to the 200 is red bearish. Slope of the 50 is red bearish. The ADX is strongly bearish. The risk index is at risk off conditions. That's the 30 period moving average of the VIX divided by the 10 period. And 1.0 is the boundary between risk on and risk off, and that reading is at 0.98, so we are into risk off. We take the z-score of that number by looking back 5,000 trading days, finding the average and standard deviation, and computing the z-score. That's the risk z. See here a 90-day histogram of that reading. In fact, it's rolled over and just gotten back into the red. Suggests more short-term volatility ahead. Not good for swing trading. We already know that from the bearish volatile conditions. The theoretical exposure of ETF2, that should read 0%, sorry. You can see the leaders for BMR here based on closing prices on Friday. See a lot of defensive sectors in there. ETF portfolio, everything cash. Mostly cash in ETF 32. Only Brazil and utilities and consumer staples remain in the buy. Dow 30 mostly in cash positions. A few key leaders in the staples area. Again, having a little bit of positive momentum. However, everything suffered this week, especially Apple and Goldman. ETF sector spiders, utility, staples, and real estate, the defensive plays, are the only ones that are above their 4-month moving average. Energy really getting crushed here. Inside ETF Max, lots of defensive plays in here as well. In the market health check, you see the slope of the 10 is down, the slope of the 30 is down, closed weekly going into the weekend. MACD histogram rolled over, briefly touched summer and then failed to get into winter, and that's a signal to be auto short, pulling away from the RL270, which is now rolled over in the last 30 days and slipping downward, confirming the bear. ETF 2 world market model, basically US below average except for the Dow and the S&P, but all of Euro-Asia weak. Only Brazil, Latin America is showing a glimmer of hope. Some of the alternate asset classes in the positives as well. ETF top 30, mostly defensive plays once more. Shifting to the daily report, just about everything firing on the auto framer. Those in the red are things that made new time period lows, and so things like Goldman, Apple, and ExxonMobil suffering, especially on Friday. Everything in the ETFs basically auto framing out well as also. Oil and oil exploration getting just smashed here. Only XLP showing any kind of strength. treasuries, Coke, and the VIX above the. They're still in the river. They're above their Bollinger Band mean, but nothing is even outside of the river, and these are the strongest sectors. Whereas you can see just how crushed these negative Z-stretch symbols are. The widest rivers, basically because of the downward pressure. Standard trade framing for the auto framers. Lots to choose from here. With this being bear volatile, I'm going to be exclusively intraday and then try to build positions out of money that's earned on winning trades using intraday gains. There's nothing even in the summer. That's how bad things are right now. Mostly the fall and then deep into the winter. So things that are deeply in the winter but still above their red Bollinger Band may become interesting candidates for relative strength when the market turns. So that's where things like Caterpillar, 3M, and DuPont are well postured. This is just how bad that negative move in GE has been. An 80x2 more than 2 sigma in terms of badness. Absolute collapse here in the S&P. Tend to get the slope of the 30 getting ready to cross its 10-period moving average to the downside. That's a very bad sign. 2 highs, lower high, a third lower high, and that suggests another move of this magnitude is baked into the cake. It had a bit of a rebound off of this historic low in terms of that slope, but that feels like it may be done. Still very volatile by every measure. Again, more room to the downside. All it's going to take is a collapse of this double bottom, and you get another move of this magnitude. That's another $6 to $8 in the S&P. And that's everything I want to cover this weekend. Keep your risk measured and your powder dry. Remember those things to be thankful for, but keep that risk measured. Safe travels if you're traveling this weekend. And looking forward to a good swing workshop in this next weekend. And we'll see you in the chat room.